All right, so in section 2.4, we're talking about comparing buying, renting, or leasing. So there's slight differences between the two. Renting and leasing are quite a bit closer than buying. Obviously, if you buy something, you are making the purchase for it, and all of the ownership transfers to you, right? You're buying something outright so that you own it. Renting, you don't own it. Leasing, you don't own it. Slight differences here. But let's talk about what a lease actually is, okay? In your textbook, it says that a lease is a contract for purchasing the use of property, such as a building, vehicle, or something from somebody else for a specified period. So, in other words, when you lease something, it's kind of like renting it, but you're buying the use of that. But there's an end point. Okay, so usually you lease for maybe 6 months or a year. In renting, the term, the time, the amount of time is maybe a bit different. A lot of times it's really short, so that you rent on a shorter basis so that you can get out of it easier. A lease is something that's a little bit more permanent. It's not permanent, but it's a little bit more permanent. So this definition in the textbook is maybe a bit tricky because it says purchasing, but you're not actually buying the property. You're purchasing the use of the property. Okay? Okay, so we'll talk more about that as we kind of go along, but you're purchasing the use. Okay, equity, was that the next one on your list there? Okay, equity. So equity is it says here, the difference between the value of an item and the amount still owing on it. It can be thought of as the portion that you own. For example, if a $25,000 down payment is made on a $230,000 home, $205,000 is still owing, $25,000 is the equity. So if you purchased a home and maybe 10 years down the road you've got half of it paid off, then the equity that's in your home is basically the difference between what it's worth and what you owe. That's how much equity you have built up in it. So it's kind of the part that would be yours if you sold it. So for example, on a home, if you bought it for $200,000 and your mortgage is $100,000 left, and let's say now the market's changed so that you could sell it for $250,000, and you sell it for $250,000 and you owe $100,000 on it, you have equity of $150,000. That's like you're to the good, $150,000. So that's sort of what equity is. It's the difference between what you owe on it and what you can sell it for. If you've completely paid off your home, you have 100% equity there. Whatever you sell it for is all gravy. That's the money that comes to you. Right? An asset, it's an item or a portion of an item that is owned. Okay, so it's property, the same as property. Assets include such items as real estate, investment portfolios, vehicles, art, and gems. I like that they put gems in there. A little bit weird, but whatever. So if you have diamonds or rubies or whatever. Vehicles, art, and gems. Okay. There you go. Okay. All right, appreciation. Okay, it's not like, yay, way to go for doing something good. Okay, this is different. If we're talking about finances in the financial world, appreciation is the increase in the value of an asset over time. So when I bought my house 15 years ago, I didn't pay very much for it compared to what houses are going for now. So my house has appreciated over the years. It's now worth, 3 times as much as I paid for it, really. So that's a lot. That's appreciation. Depreciation would be the opposite. So it is the decrease in value of an asset over time. When I was a little bit older than you guys, I bought a fairly new car, and it was used, but it was only a year or two old. But it depreciated in value quite quickly, right? So if a new car is worth $30,000, as soon as you drive it off the lot, it's now worth like 20. It depreciates that much. As soon as it's now an owned vehicle and not brand new, it depreciates in value. So that's what depreciation means. And finally, I think this is the only other sort of definition that you'll need to understand in understanding this section. Disposable income. Okay? This is the amount of income that is available to spend after all the regular expenses and taxes have been deducted. So it's basically the difference between what you make and what you spend. So whatever's left over is kind of up to you. It's available for you to buy something or to invest it or to do something. It's sort of it's called disposable. If something is disposable, you can, think about disposable something, and you can chuck it away, you can use it and get rid of it. It's something you can dispose, something you can get rid of, right? So this is like money that you have available that you can use on something. Now you're going to want to budget, right? You're going to want to make sure that you don't say, oh, I have $200 left at the end of the month, I need to go spend it on something, right? Candies and muscle shirts and high heels, right? You want to do that. You want to think it through, but that's what disposable income is, the difference between what you make and what you have to spend. Any questions? Okay. I want to do an example in the textbook that talks about the depreciation of vehicles. So if you want to just open up your textbook there. Where is it? Okay, here's your textbook. Here's where I got these from here. A little bit of explanation on what sort of these terms mean. But let's see here. Oh. Okay, I think this is the one. Yeah. Solving a problem that involves vehicle depreciation. So as I mentioned, your vehicles depreciate quite a bit. This company in particular, it's a rental company. And actually, I bought a car from a rental company. Actually, not from a rental company. It was from a dealer, but it was a rental vehicle. And because they devalue the vehicles so quickly, you can often get a vehicle that's 2 years old, and it's at a pretty reasonable price. Now, it's never been owned, so there's a risk that people are renting these vehicles and really not carrying them, driving them over, cross country and really just wrecking them, not taking care of them at all. That's the whole idea of a rental. But that's why the value is so low, really. So they depreciate quite quickly. In this particular case, this luxury vehicle rental company depreciates the value of its vehicles each year over 5 years. At the end of the 5th year, the company writes the vehicle off for its scrap value. So basically, they've used the vehicle, made money on it. After 5 years, now it's too old to rent. And so it's kind of like, what's left of it? What is it worth to them at the end of that time? So the scrap value of the car, that's something that may be a new term to you. And to tell you the truth, it's not an official definition, but the scrap value of a car, we should probably write that down, okay, as being, let's see here, how can I get to this? Yeah. So the scrap value of the car, okay, write this down in your notes. How do I get that to highlight? Maybe it's there. No. Whatever. Right there. So scrap value, okay, it's the worth of a vehicle or the worth of an item after depreciation. Okay, after multiple years of depreciation. So that's what you can write down for a definition or for an explanation. Scrap value. The worth of a vehicle after years of depreciation. All right, so in this question here, it says, what is the scrap value of the car below? Car A, which is currently 2 years old, has a value of $43,200. Okay, so remember, it's 40% each year, so you're going to have to do kind of yearly calculations, and that's what they did down here in this chart. Okay, so at the end of year 2, this is what it's worth. Okay, it's 2 years old, this is what it's worth. So the depreciation amount is 40% of its worth. So what's 40% of 43,200? Multiply that by 0.40, and you get this number. You subtract that. This is what it's worth right here, 25,920 at the end of year 4, or the end of year 3, sorry. You take that amount, take 40% off, it's worth this. Take that amount, 40% off, it's worth this. So at the end of 5 years, you have a scrap value of $9,331.20. Okay? So it's basically, you're just doing simple math, 40%, you're removing 40% off each year. Another way to look at that, if you want to do it a little bit different way, I'm going to do the scrap value. Let's say it was, what was it, 43,200? What you could do is multiply that by 0.6. This is probably the quickest way. And that gets you straight to what it's worth after 40% is gone. Right? And so if we do that on our calculators, you should get the same value that they got in the book. Did they use the same number? Yeah. 25,920. Okay, let's just see. So 43200 times 0.6. That's after 40% is gone. And 25,920, that's the same as they got in the book. Yep, 25,920. Okay, so this is 60% of its value. That's the same as finding 40% and subtracting it off. Right? Any questions? All right. Okay, in your assignment, what you're going to be looking at again is the difference between what, the cost analysis, it's called. And if we kind of go look at your textbook here, it asks for what are the costs associated, and buying, leasing. Okay, you're going to use your TVM solver here. There's a lot of examples that I won't go through all of them, but I'm just going to find that where it says the kind of the cost analysis. What do they call it? Okay, so right here in your key ideas, a cost and benefit analysis should take everything into account. That is the costs and the benefits, right? So it's sort of like an analysis. And for some of these questions, there's no real right or wrong. It's like, would you rather buy something outright and have, that property as an asset at the end of 5 years, or would you rather just rent and pay a little bit less but not own anything at the end? So some of the questions you're going to get and you're going to have to work through ask you to calculate the costs, consider the pros and the cons, and then, just basically say what you would rather do. And so these are some of the things you might want to just kind of take some time to look this over here. These are some of the things that you need to take into account. If you like buying as opposed to renting, what you have to realize is that you will have something at the end of the term. You'll own something, but you'll have paid more for it, and it'll be worth probably a little bit less than you think. If you rent, you don't own anything, but that may be something that's better for you. Maybe you want some more money, in your hand every month instead of owning an old car at the end of 6 years, right? So anyways, these are all things you need to consider.